Okay, so this is again introduction. So we'll move to introduction to IFRS and ISC. Historically, it all started around 1960, 1970, when the International Accounting Standard Committee was formed, and later it was converted into International Accounting Standard Board around 2000. The idea of even IASC was to have one global body which can set the standard for all over the world for accounting and business community. The IASC was set up in 1973. You can see here in the third point. I will supply you all the PPT after the session so that you can refer as and when needed. So you don't need to really note down all the facts and figure, but just pay attention to the key points, which is IASC formation was 1973. Fast forward almost 27 years, everyone realized that IASC as such do not have the required influence and authority to make the harmonization possible. So what is harmonization? And why IASC or accounting standard globally needed the harmonization? See, the core concept of bringing this accounting standard was that entire world should report in one accounting standard. So we did some study earlier when I was in college as well, that when one particular country calculate their revenue or balance sheet, sometimes it is quite inflated, very high. Whereas if you apply international accounting standard, it could be a lot less. So asset could go down, revenue can go down, liabilities can go up if you apply standards like IFRS. That's one thing. Why it happens, we'll talk about that later. Then there was a situation when if a company needs to get listed internationally, say in US stock exchange and UK stock exchange market, obviously the reason is capital. So if you want to globalize, you need to get global capital, right? You need to get international investments. We have heard of terminologies like FDI, FII. So you cannot get that without you start to utilize the accounting standard, which is global, right? For the global audience to read and then judge your financial position before they invest into your entity. Hence, there was a need to have international accounting standard. There was a need for harmonization as well, because you cannot really continue to prepare the accounting standard in multiple accounting statements in multiple standards, because Chinese accounting standard or Hong Kong or Indian accounting standard would be required to report in their native standard as well as international standards. It was increasing the amount of audit, the cost of preparation as well as the review and audit, everything. So while there was a need for international accounting standard, there was also a duplication of effort, cost, audit, time and effort required. So what is the really ideal situation? The ideal situation was that all the accounting standards start to come on the same page. They start to follow same set of rules and they get harmonized. And harmonization was required so that the international capital can be invested into any companies. So that was also facilitated by the globalization. At the end of 1990s, India started to get the benefit of globalization, but it had virtually started back in 1960 itself. So formation of IASC and the globalization was almost simultaneous. It may not be a coincidence. It could be influenced by the same wave of global business, that one hand everyone wants to get global trade, and on the other they wanted to report on, as per the international standard. So that was the reason harmonization, international accounting standard was needed at the global level. Then IASC felt that it has the membership of almost 170 different accounting bodies. So when we say it has the membership of 170 accounting bodies, that means the Indian accounting Indian CA, or maybe Hong Kong, Singapore, Australian CA, all the bodies were member of IASC, but they were not obliged to follow IFRS or IAS standard. That defeated the purpose of the formation of IASC and issuance of IAS or IFRS. Then IASC was reformed into IASB, so International Accounting Standard Board, which has 14 members, and each member country has 3 representatives and specialists in the IASB. The objective of that is that all the members will work towards adopting and issuing one international accounting standard, which will be globally accepted, that will be more harmonized, that will be based on the generally accepted accounting standard of various countries, so that everyone can adopt it. That has started to work quite a lot. Globally, most of the countries have now accepted IFRS. US is still setting a target. It has been like 2015, 17, every time it sets a target, but then extend it. But overall, IFRS has started to get the recognition. Any questions so far?
No, Nilesh, we're good to go.
Great. So moving forward on this history and the story of IFRS, ISC in fact. So International Accounting Standard Foundation was incorporated, and we'll see in the structure, there is a complete organizational structure of ISC, whereby the foundation of International Accounting Standard provides oversight to the International Accounting Standard Board, its monitoring committee, etc. So this is a tax exempt, typically not for profit organization. And this is responsible for high quality, understandable, enforceable, and globally accepted IFRS. Okay. Okay. Yeah. So this is what I said. ISB originally has 14 full-time board members. Each has one voting right, but have 2-3 different representatives and member, which represent that country's accounting interest and suggestions. It also has monitoring board. It has the interpretation committee. There are various entities within the overall foundation, and we'll see that pictorially as a hierarchy and diagram. This is quite intuitive. Like any financial statement or accounting standard, IFRS also has asset, liability, equity, everything is defined. So asset is typically the resource that is controlled by the entity, and liability is the present obligation due to the past events. Then equity is really the residual interest, which is all the assets minus the liability. So it follows the typical accounting equations. There it cannot be different, because globally that's the equation that is popular, and it still makes sense. So it has been adopted in IFRS as well. Statement of comprehensive income. This is something we need to pay attention to. So most of the terms are quite familiar: revenue, expenses, asset, liability. But this one is a bit interesting because it is a rather new statement in IFRS framework. Also, it reports exceptional nature of income. When I say exceptional nature of income, there are like 3-4 other examples in the next few slides. But typically, statement of comprehensive income goes beyond revenues to recognize the income of the company. For example, suppose that you are a multinational company and your business are in 20 different countries. Because of that, you have assets in various countries, plus revenues are coming from different countries where the FX is quite fluctuating and volatile. Because of that, your factory, plant, and equipment in every country will have a different value when you'll report to the home currency or the reporting currency. When we say reporting currency, is the currency in which you present your financial statement. Take an example of GE. GE is based in US and reports in the US GAAP. In the US currency, USD, as well as US GAAP. It also reports in IFRS. So if GE has to report its assets and plant and equipment, say in China, and China renminbi and US is fluctuating, then what will happen is for the same plant and equipment, which is in Chinese factory owned by GE, the value after translating into USD will be different year on year. Though you know that you're not going to sell the plant and equipment, right? Once you have bought any manufacturing unit, the plant and equipment in China, it will remain there. You're not going to sell it. But when you will translate the value of that equipment in the reporting currency, which is USD, every year you will see some fluctuation because of the FX. And that could be negative and positive both, i.e. that could be expense or income both. Should you really report that in your P&L? That's the question that we need to understand. So these kind of questions comes in entire IFRS standards. Should you report that fluctuation caused by the FX in your P&L or in your revenue? So if the FX goes up and you translate into USD, that will look like an expense. If the value goes down of the plant and equipment, sorry, in the renminbi currency, FX, it will look like a revenue. But it is not a true revenue or expense. You're not going to sell that. But still you need to reflect somewhere in order for accounting standard to balance. Should that be expense or revenue?
It might be depend upon the positive and negative. This is unrealized.
Correct. So all two statements are right. It is unrealized because, as I said, you're not going to sell it, right? It will be at least there for 10, 15, 20 years. You are going to manufacture stuff using that plant and equipment. So yes, I agree, that is unrealized. Second, it also depends on whether it is a plus or minus. So you will enter that in under revenue or expense. But the question is that right to report under revenue or expense? So suppose it is positive. No. Should that be in revenue? If it is negative, should that be in expense? That's the question.
No, this is not a core activity of the business. So it should be reported somewhere, but not on the head of income and expenses of the company.
Right.
It should go to SOI, Statement of Comprehensive Income.
Yeah. Okay. So yeah, it should go into the Statement of Comprehensive Income, SOCI. That's correct. So basically any such income or loss, both income or expenses both, which is not regular income and you're not going to realize, or even if it is plant and equipment, that will be thrown into Statement of Comprehensive Income. Of course, there are various rules even to recognize, de-recognize, make the adjustments into this. We would have seen that in IAS 32 and IAS 39. So that's one thing. The second example is when you have derivatives, right? Your favorite topics and the product. So derivative often fluctuates, right, on daily basis. Even there are 4 categories of derivatives, right? Traded at fair value through P&L, loans and receivables, held till maturity. So held till maturity will be really for the bonds, right? But the idea here is if it is a bond or if there is a need financial instrument like equity or derivative, which is not held at fair value through P&L, right? That does not go into revenue and expense. Because if it's not held at fair value, still the prices fluctuate. We have to still account it. anyway, but it will not go into revenue and expense. Then it will go into the comprehensive income. So that's second example. So IAS 39 talks about that. I forgot to mention IAS 21 will talk about the FX related fluctuation into the comprehensive income, right? So that's called historical rate, current rate. There are various mechanisms to report that. So all these similar activities, which is not part of revenue expense, goes into the SOCI. Okay, one more item that we can talk about what goes into SOCI is defined benefit assets and liabilities. Okay, of course, I'll talk about that in IAS 19 in more detail, but just to keep this topic more interesting, have you heard of defined benefit assets and liabilities? It's a rather kind of less frequent for people who are in the financial services industry, more dealing in the investment funds. But so in short, defined benefit asset and liability is relating to the pension plans. Okay. So imagine taking the example of GE again. GE has 100,000 employees and there is a pension fund for them, right? Because every employee, every organization contributes to the PF. Agree? When they contribute to PF, there is a certain mechanism how the payment is made, because it is considered that every employees at the end of their service, suppose that they have worked 30 years in the company, then the company is supposed to make a lump sum contribution into the PF fund. Okay, so in that context, based on how the investment is made for that pool of pension, there are certain assets and liability even in their pool of assets, or in their pension fund. So what happens that if those investments goes up and down, and because of that fluctuation, there is a asset or liability on daily basis or monthly basis that is resulted by the fluctuation, then employer is supposed to recognize that and add more assets in the pool. So generally we have not seen that in our financial statement in reporting, but defined pension fund work that way, and that's why the word is defined. Okay, and that's what I'm saying, that we have not seen that in various employment contract, but when it is a defined pension fund, that means you are supposed to get a specific dollar value when you are 60 years of age and you have completed, suppose that 20 or 30 years of your employment with the company, you are supposed to get X dollar after your retirement every month, right? How will you get it? A simple way will be that you earn interest from the asset, right? Let's make it very simple. If you are supposed to earn the interest on an asset so that you get your pension dollar every month, then you need to have the assets to get the interest. Who will create that asset? Employer is supposed to create that pool of asset, right? And that's why they start to make the deposit every month so that that asset is created. When employees will retire, that asset will give the return for their monthly payment or monthly pension. So when employers are bound to provide that return in terms of pension fund, there is asset and liability, and they need to maintain certain level of assets every time. And because of that, they have also exposure, that is income or expense every month. That exposure actually is also accounted into the statement of comprehensive income. It's a quite vast concept, but does that make sense?
Yeah.
Any question on that? Yeah. So it's basically just try to guarantee that at the end of your retirement, you'll get certain return, and employers try to invest enough money in the pool of that pension fund so that employees after retirement get certain minimum return. and that guaranteed program actually results into some income and expense every month, and that exposure goes into statement of comprehensive income.
Nidish, here you're talking about assets and the liabilities. So assets and the liabilities. So if I think about for the company perspective, it should be liability, right?
Great
Which
question.
perspective it should be assets, or which perspective it should be liability?
Okay, so this is how it works. I need to go into a little bit more detail. So what happens is, if we are investing, right, in that pool of asset, in the pool of the funds for employees to get the return, not only the pool will go down. So suppose that you are investing your $500 every month, okay, in that pool. So that is recorded as an expense every month. Okay, that's plain, and that will go as an expense. The element that will go into comprehensive income is different one. Suppose the asset that you have deposited for employee to get the return, asset sometimes goes down, it depreciates, because it is again subject to market, right? So when the asset depreciate, the employer is supposed to put more dollar to compensate for that asset's depreciation, right? If employer needs to put more dollar to bring back the asset value, which has gone down because of the market exposure, that expense is not like a monthly expense. It will go into the comprehensive income. You know why? Because after some time, that the same asset can go up as well. And that point of time, employer can choose basically to withdraw some of the deposit. And then it is not again income. It is a number beyond the income or expense. It is a comprehensive income. So there is a separate account which is maintained. If you have heard of, maybe in some of the accounting standard, UK especially, a statement of comprehensive gain and loss.
Comprehensive income I heard again.
Yeah, income is from the IFRS. That is in the UK GAAP. But the concept is that to answer your question, when the employer is putting the monthly deposit, that is defined anyway. So there are 2-3 different type of deposit that employers put into the defined pension plan. One is when the dollar value is defined every month, that is recognized as expense. But always remember, if you have to suppose that if you are planning yourself, okay, pension after 60 years of retirement, what will you try to do? You aim to have 2 flats, right? 2 flat which give you a minimum, say 50,000 of the rent. Okay, let's make what target. What will you do to achieve that? You try to invest some 30-40,000 every month to pay for the bank. Now imagine the price of asset or price of rent is depreciating. What will you do? Now you think that, okay, you need to increase your monthly commitment into that pool. Agree? To have a minimum amount of assets.
Yeah.
So when you try to compensate for that fluctuation, which will be impacting 30 years later, that element goes into comprehensive income. So you have always 2 components. One, monthly dollar value that you have to put anyway for all the employees' pension. That goes into expense. But whenever you have to compensate for depreciation or fluctuation of the assets, that goes into comprehensive income. That's the difference between the 2 accounts. Same pension, but the number goes into 2 different accounts based on what is the purpose. But we'll revisit that in IAS 19 as well.
Okay.
Now, next is 39, IAS 39, the one that we talked about. 4 categories: available for sale, held at fair value through P&L, then loan and receivables. So whenever it is loan and receivable and available for sale, that goes into IAS 39. It goes into the comprehensive income as per IAS 39. And that is being replaced by IAS 13 now, but more or less the rule of thumb remains the same. Okay. IAS 21, that is for FX that we talked about. Lastly, whenever there is any gain or loss because of the hedging activity of the portfolio, that also goes into comprehensive income. Because again, that is not a regular income. So whenever you have any doubt, you think that any unrealized gain or loss, the rule is unrealized. It has to be unrealized. Unrealized gain or loss is not a regular income that will be going into the comprehensive income statement. And for that matter, comprehensive income is kind of a one substitute paragraph, one substitute section at the end of income statement. Of course, in the hedge fund, mutual fund, or private equity industry, we typically have a separate statement, but that can be a supplementary statement at the end of the income statement as well in other industries.
This is one quick question.
Mm-hmm.
Like say, I have seen practically the financial statement, and I've seen like we have classified our trial balances like assets, liabilities, income, expenses, and the equity. So income basically consider the GL code starting with the 3, and the expenses starting with the 4, and the capital activities starting with the 5.
Mm-hmm.
And in the income P&L side, whenever we're taking a unrealized or a RGL, this is a part of a equity. What I've seen, this is it's a GL code is equity. Why is it so? Like just a like it's not
Got
a,
it.
might be a silly
Yeah.
question, but just to be
No,
understood.
no, this is the relevant question actually to link to more practicality. Otherwise, it will be all theoretical concepts. So, okay. 3 is your unrealized GL number, and 5 is your equity section, right?
Yeah, 3 is the income, and the 5 is the equity,
And 5 is equity, yeah.
and 4 is the expenses. Yeah.
Right. Now your question is that if unrealized gain or loss should be part of the comprehensive income, then why don't we have account starting from 5 for the unrealized, right?
Mm-hmm.
Because the confusion is, the question is between the unrealized gain and loss and equity. That's where the two concepts are interacting. Okay.
Right.
See, the equity is, and this comprehensive income is not, and I will underline, is not equity. Your equity is the capital invested by the two type of people, either shareholder in general context, and in the fund industry, it is the investors, the subscription that comes to fund from the investor, right? But the question is that equity portion basically is not same as unrealized gain or loss, because if there is any redemption, right, you are not going to kind of sell that product at the time of that redemption, right? If there is a bond for 5 years, correct, or loans and receivable for 5 years, you're not going to sell that one and give to the investor, right? Because the equity will be separated from the unrealized movement. That's the whole objective, to answer your question. Equity should be kept separate, right? Because and then the unrealized portion, because of the fluctuation in the market, that should be kept separate, because that fluctuation can change anytime. But your equity, which is invested by the investor, that is a fixed dollar value, isn't it?
Mm-hmm.
Because tomorrow,
Yeah.
if you're an investor, you say, okay, I had invested $10 million, but now I see that you're reflecting my equity as 7 million, right? And I should be able to explain that, okay, it is because here is your 10 million as it is, and I need to show it accordingly. I need to show that your equity is not impacted. Even though your total worth is going down because of market fluctuation, but your total equity, I still have to report accurately. So I have to report account 5 as 10 million invested, but then your 3 number account, which is unrealized GL, which is a loss of 3 million, that will be added. You're getting me now? So you made a 3 million loss in account 3 star. That is a 3 million loss. That will be added to your equity account 5. when you will present the total comprehensive income and gain. So there is a statement of changes in the equity, right? SCNA that you call?
Yeah.
Statement of changes in the net equity as per the US GAAP terminologies. And it is easy to use here, right? There what you do? There you will add equity 5 account and the 3 account as well. Because original equity, which is you call it the opening capital, changes during the year, and then net capital. So there your 5-star, 3-star, and maybe even 4-star, everything will be accounted for, and the final number that will be there, that will be net worth of the account and your investors. Correct? So ultimately everything is going to impact the net worth of the investor, but you need to still separate it out in the trial balance, right?
Yeah.
And
yeah, now I think I'm linking it. Yeah.
Right. And there are various risk reporting requirements why we need to have kind of, it seems often that, we are just making the entire accounting world very complicated, but risk reporting requires even further splitting everything. You yourself makes the table on the derivative 133 or all these standards in US GAAP. In IFRS, there is like IFRS 7. So we do a lot of risk reporting, and that's why we need to provide all the accounts separately. Okay, so introduction to IFRS and IASC. It's back to history. We are coming back and forth from history and current time. So 1997, the decision was taken that IASC needs to reform into IASB, and in 2001, it was formally announced. Now comes the interesting diagram. IFRS Foundation. This is like a typical trust that you hear time to time in India and everywhere, like an NGO. It is a typical NGO, not for profit organization. Okay. What is its role? IFRS Foundation appoints IFRS Advisory Council. It typically basically oversees 2-3 bodies. International Accounting Standard Board, which is the most important one. IFRS Advisory Council, that provides the technical and all the accounting specific advisories to IFRS Foundation, because it is the IFRS Foundation which will be interacting with the industry and understand what is the requirement, because IFRS Foundation is the one which monitors IFRS Advisory Council, International Accounting Standard Board, which had replaced International Accounting Standard Committee in 2001, right? And then it also interacts with International Financial Reporting Interpretation Committee. It is also called Efric, right? And its role is very, very nice. It's not something to freak out, though the name is Efric. So it appoints the members of Advisory Council, International Financial Reporting, Efric, as well as IASB. So IFRS Council, as you see, Advisory Council, it is advisor. So it reports to Foundation and provides the advisory. It also provides the advisory to IASB, because IASB is the one which prepares the first draft of any accounting standard. So if you want to probably see what is going to happen in next year for any standard like IFRS 20, 25, etc., continue to check their website. They normally issue loads of draft for the public to comment. Who? IASB. Okay. Then what is the role of Efric, Interpretation Committee? Now imagine accounting standard for internet ethics or cybercrime. Okay. Do we have any? Not very clearly. There is no proper accounting standard for various artificial intelligence and those kind of businesses. Okay. Fintech or all these smart technologies, blockchain, etc. There is no separate standard. Agree? Okay.
Yeah.
Assume for now, yeah, it's not there. So what could happen if you are wondering and you're a fintech company and quite large and you want to report everything true and fair, what will you do? You need to drop an email to Efric and say, hey guys, I have started my fintech company with two or three of my friends. It's doing very well. And I was trying to prepare the financial statement. And one was wondering that how to report assets and liability, etc. Because you need to understand, in fintech world, your assets and liabilities are not going to be very traditional. It's not going to be measured in the same way, right? And I assume that it is very natural to have question how it should be reported. So who will you go to? Interpretation committee. Why? Because if there is no standard set of rules or any particular standard issue for a particular question or industry or type of business, then interpretation committee will help you. They also have certain rule of thumb. We'll see it later. So that's rule of monitoring, interpretation committee. Then monitoring board is a kind of a succession team. So they appoint the member of the IFRS foundation. So they look after appointment, their tenure, compensation, their conduct, ethics, etc. So that's monitoring board. So monitoring board appoints the IFRS foundation. IFRS foundation supervises advisory council, IASB, Efric. Okay, advisory council, as the name suggests, advises to IFRS foundation and IASB. And it's really Efric and IASB which interacts with the public to provides the standards, rules, and guidelines for various reporting. Okay, so then you can see here, IASB creates the IFRS, whereas IFRS, Efric is appointed by a foundation and it interprets the accounting standards for IASB. Whenever there is any ambiguity or accounting standard is not in place already, interpretation committee chips into and they provide the clarity or suggestion how to report something. Are you good?
Yeah.
Great. So IASB governance and new issue books. So we talked about monitoring board, interpretation committee, which is Efric. It has 14 members. We have talked about that. The role of Efric is to interpret the application of financial reporting standard. If I'm still confused, I can go to them. In fact, I had written one email once, and providing the timely guidance on the financial reporting matters, plus publish the draft interpretation for public comment. So they will invite the comments, suggestions, because ultimately it is very hard to get a holistic view of the entire industry. In the globalized world, there are so many different situations, complications for any industry and various views. Any group or committee can never be, complete to have all the views to prepare one single financial standard. So they need to get the insight from those who are practicing in the industry, and that's why they invite the suggestion and feedback on any draft of financial statement. The financial reporting standard. So that's why I'm saying consider comments made within a reasonable period before finalizing an interpretation. ISC governance and new issue books. What is the new issue book now? So ISB has 2 volumes of standards and interpretations both. The blue book and red book. The blue book is when an entity or any organization is not going to apply the new requirement before the mandatory dates. So let's take an example. For insurance contracts, we had IFRS 14 earlier. Then 3 years ago, we got IFRS 17. So there could be certain companies which will say, okay, we will implement IFRS 17 from January 1 when it is mandatory. So that is a blue book advice. So IASC provides the guidelines for the companies which are going to apply IFRS 17 from the mandated dates only. If you are following the book, that's blue book. But there could be some companies which may like the provisions of the new standard which is coming up even if it is applicable, say from 2022 or 2021, you say, no, I want to prepare my financial statement as per new standard, even though it is not applicable now, but I want to adopt this. So ISC has the rule and the steps set out for such organizations as well, and that is called Red Book requirements. Okay, so generally, I know we all are accustomed to reporting when it is mandatory, right? When the accounting standard is mandatory, then we adopt it. So we are kind of typically blue book, right? We follow blue book. So this is how you can remember. But those who want to apply it early, those who are in the rush to apply, those who are very passionate, the red color, you know, they can utilize Red Book requirements. We talked about interpretation committee. We talked about certain industrial need, such as fintech, blockchain, artificial intelligence, machine learning, those industries. There are also space mining, right? Some companies and countries are trying to mine asteroids and various other stones in the space to get the valuable minerals, gold, etc. Right? So there is a lack of accounting standard and guidelines for them. So Efric tried to provide the guidelines. Also, it has some set of rules to guide people what to do. So, and there's a pecking order. There is a hierarchy to apply those rules. So the first thing, if you don't have the standard or any particular accounting rules, what you need to do? You need to look for the guidance in IFRS for similar transactions, similar business and issues. So let's take an example. Okay, you have developed a fintech product whereby if somebody just speak that debit my account and the transaction will complete, it will be all voice enabled, and voice will be detected by certain AI based software, which will find out that it is your voice. You develop a very nice product and you are wondering what should be how it should be recognized in the balance sheet. What should be the commercial viability, when you should really think that now it is an asset, because you cannot define something like an asset unless you set up or you quantify the value and you establish the commercial viability. Now the commercial viability establishment has certain rules and it can vary for a fintech product like this. It is a very innovative product. You don't know what to do. So you have to find out the similar rules in IFRS basically for such assets. So there are various like high-tech or manufacturing asset regulations. So International Financial Reporting Standard already has the rule to talk about how to establish the commercial viability, and when you are doing the research and development, what are the 3 phases and at what stage you can consider something an asset. So you need to look into those accounting standard or IFRS. The second, if it is still not clear, then second one is the framework. So IFRS framework that we are talking about right now, these are all the part of IFRS framework. So there are some set rules: substance over form, true and fair view, and arm's length transactions. All these frameworks are applied. Prudence, due diligence, all are the part of the framework. So you need to consider the overarching principles of IFRS. Third is the recent pronouncement from other standard setting bodies. So it could be the case that maybe IFRS has not issued the standard. However, maybe US GAAP, UK GAAP, or any other accounting board, or even Indian chartered accounting bodies might have issued certain guidelines and accounting standard. You can follow or you try to implement that one. But that should be the third option, not the first. First is when you start with IFRS rules, similar ones. Second, the framework, and third, any other accounting bodies rules. Any question?
No, it should be good.
All right, so next one is conceptual framework for financial reporting. We are talking about the conceptual framework, now it is there. That describes the objective and the concept of general purpose financial reporting. So basically, this is not an accounting standard itself. This is just an overarching principle, ethics, and rule of thumb, which kind of covers entire accounting standards. And it also tries to provide you a framework so that if there is an accounting standard missing, you can still make your own judgment. So that's the conceptual framework. What it includes, some of the key attributes of the conceptual framework is defined here, like qualitative attributes. Qualitative attribute means any financial statement provides the quantitative and qualitative data, right? The qualitative data is a little more ambiguous. So qualitative attributes should ensure that any information that you provide, disclosure notes typically, that is relevant and faithfully represented. Now, these terminologies, relevance and faithful representation, is also further defined. What is relevant? If that information provides the key information to help user get the insight about the asset, liability, revenue, or overall financial situation, basically, and it provides the key information that the user is also interested. That is called relevant phenomena, right? Now, faithful representation, what that means is the information should have certain quality if it is faithfully represented. Like it should be complete, it should be neutral and free from error. Okay, let's say I say that, okay, Vista Print is a printer company and Vista Print has 100 printers. Okay, number one information. Second, I say, okay, Vista Print, each printer is bought at historical cost, say 1 lakh rupees. Okay, so 1 lakh rupees and 100 printers, so that will, the total cost will be 100,000. 100 lakhs. Okay. Now, is that complete? Is that neutral and free from error? We need to test. Are there any printer which is damaged or not functional? I need to talk about that. Second thing, I need to also talk about that when it was bought. I'm saying that it was bought at 100,000, but I have not mentioned when. And I also have not mentioned that the cost has gone down or some other economic events in the market, right? And free from error. Maybe 3 printers were not found in the stock and it is still unaccounted for. So those things needs to be also mentioned for faithful representation. Because when I said that 100 printers were bought at 100,000 rupees per printer, it is still not false, but it's not faithfully represented. There are two different elements here. Something may not be false, but doesn't mean that it provides a complete picture. In order for something to be complete, you need to talk about all the relevant information and accurately. If anything impacts the judgment, basically, but not provided, it means it is not faithful representation. Okay, in other words, like if you know information and it can change your decision, right? Then it is a very, considered important information. And that important information should not be hidden. That should not be kind of omitted from the financial statement. You need to provide all information which can help a user take a decision. So that way you can see that there are a raft of details which needs to be there in order for the faithful representation to be there. Because anything can impact the decision-making process of users. Now, next is neutrality. Okay, are we back? Okay. Neutrality is supported by exercising caution, which makes judgment under condition of uncertainty. So in short, neutrality is about applying prudence, okay, and not having a vested interest in the presentation of the information. Okay, so the not having vested interest is if you are presenting a data about the company's financial health, the data should be so neutral that you are neither in favor of presenting it good nor in a bad way. You just need to reflect the economic reality. So there should be no exaggeration of the asset or liability. There should be all the information provided which can help the user take the decisions, and then it will be considered neutral as well as the faithfully represented. The other aspect is of qualitative characteristics. So all these are talking about the qualitative attributes of financial statement. So there are some other attributes of qualitative data, which is understandability. So you might have provided all the information. It could be full of jargons, industrial use, and acronyms, which may not help even the auditor or the general public to understand the data and details. So it is not understandable. Comparability is your data presented in such a way which can be compared. So comparability is important. Now you know why we are emphasizing this. In IFRS, we are supposed to provide the data of at least 2 years, right? All the last year's comparison.
Hi, Nitish. Hello.
So, yeah.
Nitish, looks like for me, I'm really having hard time to hear you out properly. Looks like in between your voice is kind of breaking for me. I'm not sure if that's the case with others.
No, Jagresh, actually,
Or
we
I'm
having
not.
an issue 2 minutes before only when Nidish has reconnected. But before that, I think it's working well for me, at least.
Yeah, it's working. I think
Yeah,
that issue is related to you only.
Oh. Chakresh, so try to
I am not
sometimes
sure if.
it could be a data broadband issue. So try to maybe switch off some of the data use, or maybe I can switch off the video, but still at your end it might not help. Let me try to switch off. Actually, that is needed while sharing.
Yeah, I think issue looks like maybe from my side in terms of connectivity, but yeah, please continue. I'll just try to maybe fix it.
I'll also give the recording anyway, so that you can fill the gap anywhere. All right, going.
Sure.
So yeah, perfect. So comparability. So last year data is provided in all IFRS statements. Even the table and disclosure notes provides the last year's data in the bracket. So that's one way to remember that comparability is critical in IFRS. Right. Apart from this, everywhere the data should be presented in such a way that anybody else can understand as well as compare. So the terminology should be standard. The per unit cost and value, market value needs to be reported. You also need to provide the source of the data so that comparison can be made, because most of the data are coming from some sources. In the fund industry or financial services, you will see that market data providers are there. If you utilize their input, you need to provide the source so that any user can check their data from the same source and compare the two financial statements, right? So comparability is important. Verifiability, again, similar to providing the source, right? Where the data is coming from, what is the input sources. So those needs to be provided if you are taking the broker's statement, broker fees, or market data provider, Reuters, Bloomberg, all those information that we provide in the financial statement. That is the testimonial of the need for verifiability. So verifiability is critical. Otherwise, we can quote any number in any manner, and people will not be able to rely on the financial statement if it is not verifiable. Right? It's like a reference check. And then timeliness. This is again a matter of data quality. It's called currency as well in various fields. Currency means the data should be current. It should not be too old and should be reported punctually. Right. You often see that post balance sheet event are provided in financial statement, right? That's another way to connect with this concept. If as of balance sheet date, property, plant and equipment was 5 million, but then there was a massive write-off or impact in the, there was a new launch in the market because of which the fair value has gone down, then post-balance sheet events should reflect those economic realities as well. So timeliness is important constraint, important attribute. Financial statement and the reporting entity. Typically, we consider that all the legal entities are reporting entity. There is often discussion and debate on this aspect as well in financial reporting world, that who should we prepare the statement for. Then many times we think that, oh, legal entities are the best one, but not necessary. A reporting entity need not be a legal entity. A reporting entity should be the one where you can report all the assets and liability separately. And you also see that they can operate on their own as a business. So while all the legal entity can be, in many cases, the reporting entity, but we need to also look into the economic reality as well, right? Often, a sub-component of the legal entity can also look like a reporting entity for financial statement. I expect there could be some questions.
Exactly.
Is that clear? Okay.
No. So I just want to understand, like with the example, like how we can bifurcate a legal entity and a reporting entity. If I just take example of a G company, like which you mentioned. Okay.
Right.
So in India also we have the G, and we have registered also with the some kind of a products which we are dealing in India. So we can say it as a legal entity, right? And along with that, we are reporting our business to the US also, so that they combine and they can report at their level. So that is a come into the reporting also, right?
Yeah.
So it's kind of like a legal entity and the reporting entity, both. So how we,
That's the
so
best case scenario, that when your legal entity and reporting entity both are the same. But I think the confusion will be when they may not be the same. Often, in some cases, it happens that one prepare the financial statement on the basis of legal form, but auditors might turn up and say that, okay, you need to split the financial statement, right? In FS, financial statement typically does not happen because all the legal entities are separately defined. But imagine in context of GE, right? In GE, suppose there is a aviation, right? GE Airlines, okay, in any country. Now within GE Airlines, you have international entity operating, or maybe high cost full service, and then there is a low cost no frills service, and that happens in many countries. Same airlines will have two distinct divisions. One will be like a full suite of service, like premium, everything, and another one will be no frills. Generally what happens, no frills can survive much better. That can basically have its own source of revenue. No frills will also have their own fleet of aircraft, etc. The high premium will have completely everything polished, much more kind of high-end service provisions. So they take care of the passengers' need. There'll be loads of freebies, etc. Whereas no frills will provide nothing for free, not even a glass of water for free. Now, this looks like a very typical business structure, but from IFRS perspective, it may be as two separate entity. You know why? Because their way of operating business is different. You agree?
Yeah.
Their market is different.
Yeah.
Their way of growth of the revenue is different. The economic cycle, the industrial pressure, the entire rules and regulations, so many things are different. The way they also operate, one will be taking like a big jumbo plane, another will be going for the small kind of second-hand aircraft. And there are examples like Northwestern Airlines, Ryanair in Europe, who have this kind of structure within the same company. So if your way of dealing with in the business is different, your business target are different, revenue model is different, way of servicing is different, the economic cycle, right, and the business environment impacts you differently as compared to the other division within the same legal entity, shouldn't we have two different financial statements, two different disclosure notes? Entire set of audits should be done separately, right? Because if these two things are mixed together, just because it is one single legal entity, it does not provide a clear picture to the users again, and the investors as well. Because your focus, market entire is different, revenue stream is different, business model is different, your end consumers are different, and it impacts, and the various economic cycle also impacts the company differently, not in the same manner.
So Nidish, what is the broad way? Like a reporting entity can be have a more legal entity, or a legal entity can be have a more reporting entity?
A legal entity can have more than one reporting entity.
Okay.
So every reporting entity might not be a legal entity, if that's clear.
Okay.
And in that case, what happens then? That you prepare 3 financial statements. Why? Because one will be at the reporting entity, legal entity end. In this case, GE Airlines. Then one financial statement for the GE No Frills Airlines, another GE Full Suite Airlines. So there could be 3 financial statements. But we need to have a separate financial statement for this No Frills and the Full Suite of airlines, because they are virtually 2 different organizations. Even the management could be different, and in most of the cases, managements are also different. You will have 2 different managing directors or CEOs managing this.
Yeah.
Isn't it natural that we need to have bifurcation between the 2 entities? And one may wind up as well in future. One can go bankrupt, another one can flourish. So in all practical sense, they are 2 different entities.
Yeah.
Next one, substance over form. What is substance? Here, substance is reality check. In fact, the previous example that we talked about was also a matter of substance over form. What is form? Legal definition. I think if I replay our previous discussion, that will exactly fit into substance over form as well. Legally, the 2 entity of the airlines was same. In reality, in economic substance, they are not same. They are 2 different entities, right? Should we follow substance? Yes. Should we follow the economic reality? Yes. That will give a better picture to investors and the users. Should we just go by form? No. That brings me to another important aspect of IFRS. Why IFRS became more popular and came into force is because IFRS, as opposed to some other dominant GAAP, I would not say UK GAAP, but US GAAP actually. US GAAP and IFRS have two distinct attributes. US GAAP typically goes by the rules, the checkbox, yes, no type of answer, right? In IFRS, there's no particular rule book or yes, no kind of requirement. It says that, oh, maybe this or that as well, but you need to reflect the reality. The onus to prove that you have provided the correct information is on the director or and the auditors. In fact, more on the directors. It is not sufficient. So let me take an example. The entire audit took place, financial statement was prepared and sent to the investor, and on that basis, some investments were made. 1 year down the line, investors found out that not all the information were provided in the financial statement, right? And there are clear evidence that some of the information that the investor should have known was hidden from them. Might have went to the court, and it often happens as well. The court asked one question: which accounting standard did you follow, right? If this statement was prepared under the US GAAP, the directors can go free because it is easy to complete all the information requirement in US GAAP. If you have provided the certain information as per the checkbox, the checklist in the US GAAP, your liability is fulfilled. You're not liable in that manner, unless there is an amendment to provide more information. So if you have provided all the basic information, you are not, responsible, or you're not considered to have done provided untrue information or have done any fraud in the financial statement. But if you're following IFRS, the judge might say that you have hidden the information and you have breached the accounting standard, because IFRS does not say that, okay, if you have provided all this list of information, that is sufficient. It will say provide any information which is important and relevant, and it can help the user to understand the situation better. If it can change the decision of the user, if that information is so important, you need to provide it. It is also called material in the language of audit. The information that you are not putting into the financial statement, is that material information? Materiality check. If it is such an information that can change your mind as a user, it is a material information, and you are supposed to provide that in the financial statement, no matter what the rule book says. The rule of thumb is that you need to provide all the critical and important information. That means, in short, substance over form. The reality of the economic transaction is much more important than the legality. So that's why it is saying here, because at certain times the legal form of a transaction may not provide a true and fair image, and apart from the fact that legal form is of great importance, it may disregard the present relevant knowledge. So present economic reality is much more important rather than legal information only. And it is, of course, judgmental, it is subjective, but for directors of the firm, they would be definitely knowing what should go into the financial statement as important information. If they hide anything, they are liable. Next. A quick question, a scenario. A company buys vans from bank under lease agreement. So typically, lease are of two types: financial and operating lease, right? So often in operating lease, basically, the ownership is held with the owner of the lease. So they are called lessor. If somebody has given you the printer on the lease, they are called lessor, and the company that gets it and utilize this is called lessee. In the traditional definition, in the US GAAP environment, the organization need not report that on the financial statement as asset and liability. But in IFRS, you need to recognize an asset and liability both. Why both? Asset because the printer is being used by your organization, right? Your organization should reflect that as an asset. Even if legally the organization is not having the name on the ownership document, but it is the one who is using this for the entire economic life of the printer. So in reality, substance, organization is the owner. Now, why the liability? Liability because in 10 years, you are supposed to pay 1,000 rupees per month next 10 years. So what will be the equivalent amount today? So 10 years means like 1,000 per month means how much? 120K for next 10 years. Present value, it should be around 95K. Present value will be less, right? So 95,000 of the liability needs to be lump sum recorded in the book as a liability. Now, your financial statement looks completely different. Your current asset ratio, your various ratios will look completely different because now you have asset and liability both. Actually, in many cases, current asset ratio, acid test ratio, current ratio, that will be worse if you report the printer in your balance sheet as asset and liability both. Hence, many times companies prefer not to report this, which is not right in IFRS world. In the true economic sense, it is not the reality. It's not true and fair view. It's not substance. It is a legal view. But IFRS do not permit this. Does that make sense?
Yeah.
All right, great. Another example.
Nitish, just so I understood it correctly, what you're saying,
Yeah.
that this particular lease which we just saw, from IFRS perspective, this needs to be reported in assets as well as liability side if we are preferring IFRS standard. But from US GAAP perspective, it can be reported in income statement, and companies generally do not report in assets and liability side, and their ratios and all look good from US GAAP side, right?
You're right. I can help you one more point. So typically, even in IFRS and US GAAP both, you need to pay that monthly expenditure anyway. So IFRS and US GAAP both will have some, 1,000 of the expense recorded every month anyway. But the difference comes in the balance sheet. IFRS will have asset and liability both. US GAAP will omit that. Yeah, go on, please.
Yeah, so I know from US GAAP perspective, there are certain, guidance. There are, 3-4 conditions. If you meet those conditions, you need not disclose, this lease in your balance sheet. But do we have any guidance from IFRS perspective, or it just straight away if you have got, lease contract agreement, you need to disclose in your balance sheet? Is there any kind of conditions, or it just straight away mandatory to report in balance sheet?
Is the first condition. There are conditions and the rules as well, and how much number you need to quantifiable number that you need to report. So there are complete mechanism how the way I calculated the present value of that. So if you are paying 1,000 for next 10 years, it will be 120K. Then you calculate the present value. So when you use the present value, there will be a kind of discount factor. And then how do you value that? So there are complete mechanism as to how that should be reflected in the books. Then again, that will also be subject to amortization, depreciation, right? Because it is a asset in your book now. So the depreciation will also comes into this. So you are going to represent not only the expense, the monthly money that you pay, also you need to reflect depreciation. Now, within that expense that you are the monthly installment that you are paying to the lessor, right? that will be split into two parts. If you take this as a loan, because you are reflecting this as a liability, so this becomes a loan. If you pay monthly installment, that will be split between two components, right? Capital and interest, isn't it? In IFRS world, so that will be reflected into capital and interest, and there is a standard how we do that. So when we'll go to those chapters, that is in IFRS as well, we'll talk about each steps and calculation how it is done. But yeah, to answer your question, there are complete set of rules how it should be reported, and there are detailed calculation for this.
Sure, thanks, Nidish.
Wonderful. So the next example, I think it's the similar. Yeah, so another example is for the position of the van, and company will own those vans from the economic point of view, but it will not be recognized as the legal owner of the vans until it pays the finance installment. So it's saying that the agreement, no matter what it says, that the company, or maybe you who runs the company, even if the legal agreement say that you are not the owner, it doesn't matter. In economic reality, you are the owner, you need to reflect that in the balance sheet. Then comes another example on substance over form. It's a long scenario, but I'll just quickly discuss this. So it is really saying that the similar to the lease, the printer lease, it could be for a building as well, right? And the concept that it is talking about is useful economic life. Okay. IFRS says that if you own any asset for more than 90% of its useful economic life, you need to reflect that as the asset. Or second condition, if you are going to pay 75% or more of the fair value of the asset, then also it is your asset. Doesn't matter what the agreement or the legal documents are saying. So it could be applicable for land, property, plant, equipment, any asset on the planet. So they have set up some percentage and quantitative rules so that there is no subjectivity on that ground. There will be clear-cut situation when it has to be reflected as the asset in the book of the lessee, not the lessor. Lessee is the company which is enjoying the benefit of the asset. Lessor is the one who is giving to others. Another great concept, prudence concept of accounting. Prudence is really talking about applying a conservative approach in simple English. So whenever we say, like conservatively speaking, it is only for this much. That is a prudence. But there is a downside risk as well of this. When you're talking about the asset, the prudence say, oh, don't inflate. Say if an asset is valued as 1 million by one valuer and 0.8 million by another valuation expert, you should go by 0.8. Be conservative, be prudent. However, if you have a liability and based on certain measures, like because liability you can measure in different ways as well. If you utilize a discount factor 10% versus discount factor of 8%, for 10% your liability will be less because you reduce by 10%, right? You divide by 10%, your liability will be less. If you apply a discount factor at the rate of 8, your liability will be higher. So prudence say estimate your liability little higher. Or the higher ones. Don't estimate the lower liability. So when it comes to liability, estimate higher. When it comes to asset, estimate lower. So example is this. Provision for bad debt and doubtful debts is reported in the receivable section. Okay. So the provision does not show the data that have resulted as bad debt. Rather, it shows the data that may end up as bad debts. Now you know. So it's trying to take a more pessimistic view, more negative view, and it is taking worst case scenario, that what could go wrong. It is not saying that something has gone wrong or debt is not going to be paid, only that is bad debt. No. If any debtor is likely to not pay you based on their trading history or credit rating or profile, even that should be shown under the provisions for bad debt or as a non-performing asset or bad debt under the prudence concept. So prudence is taking a little more worst case scenario approach. Then second one is the one that we have talked about today quite a lot, IAS2, inventory accounting. So there is a concept of lower, so when the inventories are valued, it is considered like to have multiple values. One, when you buy this, and again, it could be LIFO, FIFO methods, so original cost. Second is net realizable value. So net realizable value is really when you are able to sell something on the market. So market value minus any commission, the transaction cost charges. So if you sell something in the market, the net economic value of something minus all the transaction charges is your net realizable value. That is one number. Second number is your cost. And it often happens in the market, especially to remember this, you can utilize the electronic gadgets. If you buy a mobile today, Samsung Note 20, if it comes if it is to be like 1.5 lakhs in the market, and 6 months down the line, there's another model launched, the value of that phone goes down. It could be 1 lakh only. So here your net realizable value or the economic value of your mobile phone is only 1 lakh, but your cost is 1.5 lakh. How the costing is done in IAS or in International Financial Reporting Standard? It talks about taking the lower number of the two. So it applies the prudence concept in the valuation as well. It says that take the lower of the two, be it cost or the economic value, whatever be the lower, that should be the one that should go into the balance sheet. What happens to the loss? The loss is immediately recognized in the P&L. So debit the write-off amount or the loss. Sorry?
Is it different with the impairment and all this one, or is it linked somewhere? Like an impairment, we are doing the calculations for the asset, for the basically equipments or any kind of a lease, and we will see if it's more than as per my market value or less than the accordingly I need to book. So it's somewhere linked with that, or yeah.
It is a very same thing. It is the same thing. But the reason I just chose a couple of examples from the entire suite of IFRS is just to showcase that how prudence concept impact your entire set of accounting standards now. So now when we will talk about all this concept, you will be able to link that, yeah, we have talked about this as a framework. So this framework, this approach will be applicable throughout. So as you said correctly, that measurement, recognition, de-recognition, write-off, depreciation, every time, whenever you see that why they are exaggerating the write-off or the negative situation, it is because of the prudence. Why we are taking the lower of the two value for asset, it is because of the prudence. Prudence try to reduce the value of asset and increase the value of liability when everything else is same. And yeah, I mean, there is a quite big sections where, and in various accounting standard, we talk about measurement, recognition, de-recognition, write-offs. And then there are provisions of, again, something can be reduced, but based on some condition, it can be further increased. But such transactions goes into comprehensive income. if you have a long-term asset held for sale, or held for sale for say 20 years, and every period you need to do the valuation, it keeps fluctuations, then there are some rules as well, when you can recognize at lower value, when you can reinstate the higher value, even that is possible. And there is a rule for all this step in IAS 39, IFRS 13, IFRS 7, all talks about this. Next one, true and fair override. So again, this one is suggesting, in a way, it's kind of a different way of saying substance over form. So true and fair override means if any legal definition or any documentary evidence. So suppose that you have a documentary evidence, some valuation expert provided the value for asset as 1 million, okay? But as the director of the company, you think that, okay, 1 million is quite high because the market is quite depressed, or you know that there are certain problems in the building or in the equipment. It may not take, it may not be sold for 1 million. Then you should be the one who should flag and say that, okay, true and fair view is less than that. So true and fair override means like all other rules, be it legal, be it accounting, cost, everything should be tested again, and true and fair value should be printed everywhere. So true and fair view should be taken everywhere with regardless of what the laws, Companies Act, etc. are saying. So that's kind of a prudence rule again, or the substance or form, because you need to reflect the reality and true and fair perspective in the financial reporting. And that's nothing different from our earlier discussion, that the legal terminologies could be something else. Legal value can be high, or you may not need to provide the complete picture legally, but true and fair override says you provide whatever is useful for the investors to make the right decisions. So here, for auditors to discharge their legal and professional responsibilities, it's also called fiduciary roles. It is therefore necessary that they should stand back as they approach finalization of an audit and check whether this entire financial statement is providing true and fair view. So simply, you take a very, it's an interesting situation. So you have finalized the entire financial statement, and at the end, you still feel that it doesn't look like that this company will survive long. There are a few things which is going wrong. This business model is not long lasting. It also seems that the debtors are not going to pay back. Somewhere it seems that the receivable bill, which is outstanding for some time, it may never be realized into the revenue. You think that there are a few things which is wrong, and the company may end up, bankrupt soon. Now, that should be a check, sense check at the end, and you need to really see what is wrong. Something is not reported correctly. And that's where the concept of breakup basis versus the going concern basis also comes in picture. You need to really understand whether the organization can survive. If you have decided to prepare the financial statement or audit the financial statement on the going concern basis, is that an accurate view? Now, what is going concern basis in that context? When the financial statement is prepared, assuming that it will continue in future, and there is no chance of bankruptcy in the foreseeable future, everything is good, then it is called going concern basis. When that is not the case, it is breakup basis. Why it is important? Because in the going concern basis, the assets and the liability will have a different value as compared to the breakup or bankruptcy basis, because asset might not get the full value. The liability will require to be paid more aggressively, or it can even go higher. There could be various covenant from the banks. So breakup basis and going concern basis can be checked when the audit is being finalized, and auditors need to take a step back and see whether the entire financial statement is making sense at the high level. So here comes some definition again. Asset, which is economic resource controlled by the entity. Generally, economic resource should have all the legal rights, right to use, sell, or pledge the object. Now, who owns the asset? The definition of ownership is different in IFRS. Somebody who has the control or influence on the asset is deemed to own the asset. Also, it can only be owned, so any asset can only be owned by one party, one owner at any given point of time. Going back to our discussion about the printer or the asset earlier, it seems that legally the lessor owns the printer or the asset, but in substance, in reality, the lessee, the company which is using this, is the owner. So it is important to understand and note down who is the real owner when the discussion on the asset starts. When the balance sheet is being finalized or audited, the ownership should be checked for each and every asset. Same goes for liability. Who has the legal obligation to pay? And that should be only one person at a time. And there comes the faithful representation, because liability should not be underestimated, should not be omitted. There has been cases of balance sheet financing for companies such as Satyam, Enron, Parmalat, because of which the Sarbanes-Oxley Act and then came in 2001, and subsequently in 2013 and 14, Frank-Dodd Act also came in picture, because various assets are brought into the balance sheet, liabilities are omitted, sometimes assets are existing, but that is given to another subsidiary of the company, which is controlled by another director. So there are many ways of manipulating the financial statement, and that's why the faithful representation is very important, so that the complete information is captured. Any questions so far?
No, Nilesh, very good.
So are you good with the faithful representation, neutrality, true and fair view, prudence concept, substance over form?
Yeah.
Great. Here comes another kind of a reiteration of the financial statement elements: equity, income, expenses. We have talked about this. And finally, some question, answer, and discussion points. Okay. We have finished at the very right juncture. We have 15 minutes and some question and answers to discuss. So, are international financial reporting standards recognized in all financial capital market in the world? Questions to think.
No.
Precisely. Majority of the countries have accepted.
No, right?
Going, yeah, your answer is correct. Your answer is correct.
Okay.
I will add, however, because majority of the countries have accepted it, remaining are planning to adopt, and there is third category. Actually, there are four categories. The third category is when they are harmonizing their accounting standard, like even Indian accounting standard, right? Indian AS is harmonized with IFRS. Okay, and then there are fourth standard. Very few countries which are not working on it, and they don't have IFRS on the priority list. And we have talked about like why it is important, why harmonization is taking place, and what are the benefit of IFRS. It gets more capital. It becomes, it makes the companies more competitive. Then because then you can list in international market, You can attract FDI, FII, you can attract international investments, you can get the private equity investments in your firm, right? Now we are in a globally connected market, the capital flows across the world. So IFRS brings all those benefits. Comparability, because almost if 100 plus companies and the countries are adopting this, then your financial statement will be comparable with any other financial statement in other part of the world. If you are performing well, you can get the visibility as well as the investment. Also, it builds the trust. If you follow a financial accounting standard, which is not consistent, which is not high quality, which is not widely known, which is not globally accepted and respected, then the quality of the financial statement is under question as well. Even if you say that, oh, I made a growth of 25% vis-a-vis last year in the revenue and sales and the profit, etc. People will say, oh yeah, I know, but how can I verify? I don't understand the financial standard that this statement follows. If it is following XYZ accounting standard, people might not have the trust on the numbers. And we have seen this. There have been substantial research which found out, I don't want to highlight the country, but it found out that certain countries' accounting standard just reports the profit and assets 40% higher than IFRS. So these are some of the benefits that we need to always remember for IFRS. Now, what are accounting standards and what is the difference between IAS and IFRS?
So the one difference which I know is IAS is before 2001. I mean, whatever standard was uh, announced from, let's say, 1973 to 2000 or 2001, right? When this committee was there in place, and then in 2001, this was this International Accounting Standard Board was formed, and from 2001, all the IFRS standard came into picture, and which is kind of going on, right? Every now and then there's new standard coming up. So that's the difference, I think.
Yeah, so you nailed this part quite correctly, that all these standards issued from 1974 to 2001 in the era of IASC, because IASC was prevalent until 2001, was IAS. And from 2001 to date, under the supervision of IASB, Accounting Standard Board, all these standards are now called IFRS. However, they are the same body, same framework, and same applicability. It's just that they are updating it. So they are the same, and both now are kind of comprehensively called IFRS. So even if you're talking to any auditor, they will refer IAS 39 and they say that, you need to follow IFRS. So now everything is called IFRS. Great. Some more questions. What is the role of the IFRS Interpretation Committee? Only one answer is correct, by the way.
This one is the Efric, right? The Efric committee,
Yes.
which kind of interprets the IFRS standards, and work with IASB board if there is any requirement of new standard or new guidance, like you mentioned, the internet industry or artificial intelligence companies, if they need to prepare their statements and they need any guidance, since there is no specific IFRS or ISC for those kind of companies, they may reach out to IFRICs and seek for the guidance in terms of for their preparation of financial statements.
Exactly.
So for this one, I think it should be either B or D.
I think it should be the D, because it is talking about the harmonization of the regulations. So basically, this is the responsibility of the interpretation committee
I think it should be C, Nish.
Very good.
See, I have to use the lifelines. Okay. So first,
C.
okay, let's make it lifeline. Okay. I'm going to remove two options. And the two options I'm going to remove is A and D.
Then C.
Okay, that's the answer. So let me clarify. It is very interesting question. Many times it is confusing. So it looks very tempting, the D. Actually, prima facie D looks the correct answer because it is saying work generally for improvement and harmonization of a regulation, accounting standard and procedure relating to the presentation of the financial statement. This is like IASB. This is the role of IASB. It is very wide. It's saying that you need to improve the harmonization across the world and the regulations. You need to come up with the accounting standards and the procedures relating to the presentation of the financial statement. So it is too wide. That's for IASB, actually. The one which sets the and prepare the draft based on the support from advisory committee as well as the Efric. And it reports to the monitoring committee. So D is for IASB, C is for Efric, because if you all explained quite well Efric's role, but then if you take a step back and see what it is really doing is, it is saying that okay, if there is no standard in the market anywhere, then come to me and I will clarify, right? Isn't this what we said? If there's no acceptable rules and regulations in the market,
Yes.
Yes, correct.
in absence of that, I will clarify. That's Efric. So it's saying unacceptable treatment in the absence of authoritative guidance. If anything is missing, then Efric. Hence C. Right? So, introduction to IFRS and IASC QA. Which of the following is not one of the four enhancing qualitative characteristics?
Second one, B.
Correct. Because we had a discussion on this. Understandability is required. Comparability, very, very important. Timeliness is also called currency. Something that needs to be current. So materiality is not part of that. Great going, great work. And these are the question, very ACCA exam standard question. So it's not very simple. This kind of question that you are going to face in the exams. Now, the definition of an asset includes which of the following terms? 1, 2, 3, 4. Which combination?
It's second, 3, 4 should be applicable. Control.
I think
Control.
the past transaction should not be the part of the effect, right?
No. So the past transaction is based on to be receivable. So I think so.
It
That
should be. It
part.
should be B. I think. Should be B. One, control and economic benefit
Yeah, it should be.
based on past transaction. But ownership was also there, right? I think it's B, I guess.
Or it's
It should be the B because ownership is not a part of asset, it's a part of the equity, right? Ownership equity, statement of equity.
No, ownership may not be necessary because if you see in lease agreement, the lease contract and all, right? I think ownership may not be mandatory, but other 3 points looks like related to asset. 1, 2, and 4.
So, but if you're talking about the lease and all, so I think so ownership also part of the asset. Then in that case, it should be the A. All are the part of the asset. The lease also in the lease contract also we have ownership, and
yeah.
we are treating as the asset and as well as liability both. So any of that part of the ownership. So basically, if you
So let's hear from Nidish what Nidish says.
Yeah, I think majority of you are agreeing to B, which is a good sign. See, the
Yeah.
ownership, if we reflect to our example about the lease, right? The person never had the ownership. The company never has the ownership legally. Ownership is somewhere else. Control, there is no debate. Control has to be there.
Correct. Then it should be B.
Hmm?
Right.
No, the control has to be there. B, right. Sorry, yeah, B. When you said B, I was looking into C option and yeah, control has to be there. There's no debate on this. Future economic benefit, that's the simplest option, right? Ownership, that is not material. It is really who uses that is how we define asset. And fourth, past transaction. That is generally considered the basic. Like if you just start using something and get the benefit without having a past transaction, it is not asset. It is just accidentally somebody is trying to get the benefit, right? So for example, you go to the park, right? And you sit down somewhere, you are getting the future economic or you're getting economic benefit. You are going to park, nearby park every day, or you are controlling certain part of this. It does not make your asset, right? You need to have some investment, some transaction in the past, only then it will become your asset. Otherwise, people can get the control and future economic benefit of various things. It does not become your asset. So past transaction is important. What is not mandatory is ownership. Is that clear now? Or
So, yeah, Anil, I have a question here.
yeah,
Of course, it is the not part of the asset. I'm talking about ownership only. But
okay.
as per the question, like nowhere is mentioned that what are the mandatory of asset include which of the following, right? The question is that definition of the asset,
Hmm.
whether it's the mandatory or non-mandatory. It doesn't. I think on based on the question, but definitely we need to take the ownership of it. That is my point.
Oh, all right. So now I see your question. This question is actually in the context of IFRS, right? If I change this question from a legal paper, okay, now another twist comes in the picture. If the same question appears in a legal paper or in US GAAP, the answer choice will be different. Here we are discussing this from the context of IFRS. If I just remove that, the header, introduction to IFRS and IASC, then ownership becomes important. You can't have an asset without ownership. Does that make sense? So in the context of IFRS only, it is saying that, and of course, mandatory versus non-mandatory is not the discussion. There I agree. It is saying that how do you define asset? Of course, you need to have the control and you need to get the economic benefit. These two things are not debatable, that's fixed. But ownership and past transactions. In the world of IFRS, ownership does not mean anything. Let me give another example to clarify this. When we'll talk about the consolidation of the account, right? There's a word called equity investment, associate investment, and uh, full full consolidation, right? So the interesting concept comes influence and control of the entity. So sometime what happens that a company A has invested into company B only to the extent of say 25%, but they have to consolidate the entire books of company B sometime. Why it happens? Because people will say that, okay, company A is only investing 25%, but has the influence and control on the entire business. In that context, it is considered that company A owns company B. Entire operation, entire business is owned by company A. Even if you are just having you are investor of 25%. Technically speaking, legally speaking, 25% investment is not considered ownership. But from the IFRS rule book, IFRS 10 and IS 28, 29, it is considered that you need to add the entire book of company B just like you own this, even if you don't. Why? It is a control and influence which counts. legality does not matter. So in any context in IFRS, whenever you are able to exercise your control and influence, then you become effective owner, even if legally you are not. So if definition of the asset should include ownership, not really. And that is only in the context of IFRS. If you change the context, accounting standard, or maybe any other exam, then it becomes a different option. Does that clarify or confuse you further?
Yes, clarify.
It can go either way. Such questions are very, very conceptual and debate prone. So that's why it is good that we continue to discuss on the same class. Yeah, so ownership is kind of a very secondary item in the world of IFRS. And throughout all this discussion, we will see that. Next one. The principle of commercial substance over legal form is being applied when? Which is the option? Should I use 50-50 rule of lifeline? You can invoke any of the lifeline.
I think it should be C.
You spoiled the game. Not applying 50-50.
I was on mute.
Oh,
So I said I think. I am not sure.
oh, that's fine. Then we can take the audience poll. What others think? Why commercial substance is not applicable in case of allowance is made for doubtful dates? Even there we are applying, we are trying to provide true and fair view, substance over legal form.
Because substances, yeah, Nidish, when you explain about the substances, you have mentioned that in case of gain, we need to take it very less, and in case of I would say expenses,
Yeah.
where you mentioned that it has to be expenses is more doubtful.
Okay.
Yeah.
And which concept was that?
It was substances over
No.
Substances and form, I think. Form. Legal form. Substances and legal form.
The concept that you explained was prudence.
Prudence.
You take a conservative approach.
Yeah.
Reduce your asset estimate and increase the estimate of your expense and liability. So D is actually prudence. Commercial substance over form is being applied in C, because as per the discussion about the lease and the building and the asset, here we are saying that okay, capitalization is done, like buyer is trying to own the lease. The buyer had the option not to own the lease contract, because the lease means it is not sold, right?
Yeah.
That means you can choose not to reflect in your balance sheet. But the buyer here seems to be very honest and straightforward, saying that okay, it is let's capitalize, means put in the balance sheet. Normally it is said that owned or bought when you just have asset. When you have word capitalized, in that case you reflect asset as well as liability. So C is where buyer is following the rules of substance over form. So C is the option, is the answer. All right, we are going good. Monitoring board is responsible for what?
I think D.
Setting on work plan for IASB. By the way, monitoring board is actually one of the critical roles between IFRS, foundation, and the bodies plus public authorities. It interacts, it's like an interface. It's a computer screen. It interacts with the public and different authorities and the industry, right? So C is definitely yes. It also supervises IASB. It's a manager of IASB.
The points.
Overseeing, right? IASB.
Okay.
So the foundation.
So it should be the C, right? Okay.
Right. Okay. Monitoring board provides formal interaction between capital market authorities and IFRS foundation.
And it should be C.
Yeah. So it bridges the requirement for external world, and then it says that, okay, guys, whatever you do, follow what the world is looking for, so that they are always latest, most accurate, updated for the external business world. Okay. So these were 6 7 questions to refresh the entire discussion. The good news is, by the syllabus and the content, we have covered 15% in this one class. And I will, how to send this? Do I have the email? Can you send me the email of all three?
Yeah, sure. We will. Better you can send that through the email only.
Yeah. So I'll send this through the email, and you can go through that and revise often. This is a very, very important part of the examinable document. And lastly, just about me. That's it. So the next one will be on Wednesday morning.
Yeah.
Okay. Any last minute question?
So, Nitish, before like close out, last question is like how we can go through it. Like today, what is the session you have covered?